Let's imagine every quarter Tom gets paid, not from a second job, not from a side hustle, from Coca-Cola, from Johnson and Johnson, from Procter and Gamble. Real cash deposited directly into his brokerage account while he's at work, while he's asleep, while he's doing absolutely nothing. And for years, that felt like proof. Proof that he had figured out what most investors never do. Proof that his money was working harder than his colleagues' money. Proof that retirement, real retirement, was already arriving a little at a time in his account every 90 days. He was wrong. Not about the dividends. Those were real. He was wrong about what they were actually costing him. Because at the same time, Tom was watching his dividend payments grow, a man named Harry was doing something that looked, by every visible measure, like nothing. He bought one index fund. One. Every month. He never researched a single company. He never tracked a yield. He never checked whether a dividend was qualified or non-qualified. He just bought the entire stock market and went about his life. No stories to tell at dinner. No quarterly notifications to screenshot. Just a number going up on a screen. 30 years later, when both men sit down to compare what their strategies actually built, the gap between them is not a small difference in approach. It is not a matter of opinion or personal preference or investment philosophy. It is a gap of $370,000. And the part that will stay with you, the part that should stay with you, is that Tom never saw it coming. Because every single month for 30 years, his account went up. His dividends arrived. His strategy felt like it was working. That is exactly how the most expensive financial mistake in retail investing stays invisible for 30 years. This is not a story about who was smart and who was foolish. Tom was not foolish. He was responding to the same marketing every retail investor encounters. The idea that passive income is the ultimate financial goal, that dividend checks are evidence of wealth, that getting paid without working is the definition of financial freedom. That story is everywhere. It is on YouTube. It is in best-selling books. It is what financial influencers build entire audiences around, and it contains just enough truth to be genuinely dangerous. Let's go back to the beginning. Because to understand what actually happened, you need to understand what each of these men actually bought. Tom is 30 years old, earning $75,000 a year. He opens a taxable brokerage account and begins investing $1,000 a month. He builds a portfolio of Dividend Aristocrats, companies that have raised their dividend every year for at least 25 consecutive years. Coca-Cola, Johnson and Johnson, Procter and Gamble. He adds some high-yield ETFs to boost his income, a few REITs for additional yield. His average dividend yield lands at 4%. Every quarter, real money arrives. He reinvests it automatically. It feels active. It feels strategic. It feels like he is building something tangible. Harry is also 30. Same salary, same city, same tax bracket, same monthly investment. He opens an identical brokerage account. And then he does something almost embarrassingly simple. He buys VOO, Vanguard's S&P 500 index fund, every single month. One purchase. The entire American stock market. He never researches a company. He never tracks a yield. He walks away. Nobody at a backyard barbecue has ever said, "Let me tell you about my index fund." It doesn't sound like a strategy. It doesn't sound like expertise. It sounds like giving up. But here is what nobody at that barbecue tells you. Feelings and math are two completely different things. And what is about to happen over the next 3 decades is going to expose every assumption Tom made on day one. For the first 5 years, Tom looks like the obviously smarter investor. By year 1, his portfolio is paying him roughly $480 in dividends. Year 2, $1,000. Year 3, $1,400. By year 5, his portfolio is throwing off close to $2,800 a year. Every quarter, money lands in his account that he didn't have to lift a finger for. It feels like proof. Harry, by year 5, has watched his VOO position grow to roughly $73,000. But nothing is arriving. No quarterly check, no notification, no cash. Just a number going up on a screen. Tom has stories. Harry has a balance. But here's what Tom doesn't see. And here's where this story takes a turn that the dividend investing community almost never tells you about. Every single dividend payment Tom receives is taxable income. Not eventually. Not when he sells. Now. In the year it arrives, whether he reinvests it or not. And it gets worse. Qualified dividends, the kind from major U.S. companies held for at least 60 days, are taxed at long-term capital gains rates. That's the friendly version. But Tom also holds REITs and high-yield ETFs for the income boost. Those dividends are classified as non-qualified. They're taxed as ordinary income, the same rate as a paycheck, up to 37%. Tom is paying taxes on income he didn't choose to receive, income that wasn't actually new money appearing from somewhere, income that was, in a very specific financial sense, his own share value being handed back to him with a tax bill attached. This is not a controversial opinion. In 1961, economists Franco Modigliani and Merton Miller published what became known as the dividend irrelevance theorem. When a company pays a dividend, the share price drops by exactly that amount on the ex-dividend date. A stock trading at $100 that pays a $2 dividend opens the next morning at 98. You didn't gain $2. You moved $2 from one column to another, and then you paid taxes on the transfer. That's not passive income. That's a forced partial sale of your own position with a tax consequence attached. Wall Street has known this for 60 years. Tom's YouTube feed never mentioned it once. Now let's talk about what that annual tax cost actually compounds into over time. This is the number that should make every dividend investor in a taxable account stop and recalculate. Tom's annual dividend tax drag works out to roughly 0.5% to 1% of his portfolio value each year. In any single year, that sounds like almost nothing. In year 1, it's a few $100s. In year 5, it's maybe a few thousand. But over 30 years of compounding, a 1% annual drag does not add up to a small number. It turns into roughly $300,000 in lost wealth over a 30-year investment period on the kind of contributions Tom is making. Not $30,000, not $50,000, $300,000. Gone. Not in any dramatic moment. Not in any single bad year. Just quietly, month after month, through the steady friction of annual taxation on income he technically never needed to receive yet. And that's before we talk about the returns themselves. Tom's dividend-focused portfolio, by construction, underweights the sectors that have driven the largest share of U.S. market returns over the past 2 decades. Dividend portfolios concentrate in utilities, financials, consumer staples, and energy. They systematically underweight technology. They underweight the sector that gave us Apple, Microsoft, Nvidia, Alphabet, and Amazon. The companies that have compounded the fastest in the modern market era. Tom didn't make a decision to opt out of the technology boom. He made a decision to build a dividend portfolio, and that decision made the technology opt out for him. He just never saw it framed that way. The result is a return gap of roughly 1% per year. Dividend-focused strategies have historically returned around 9% annually over long periods. The S&P 500 has returned closer to 10%, 1%, every year, for 30 years. And then there's the danger that lives inside the high yields themselves. AT&T spent years being marketed as one of the safest dividend stocks in America. Reliable, boring, predictable. Income investors loved it. Then in 2022, AT&T cut its dividend nearly in half. General Electric, once one of the most celebrated dividend payers in history, slashed its dividend from $1.24 a share annually down to a single penny. Wells Fargo cut its dividend by 80% during 2020. Every time one of these cuts happened, it didn't arrive alone. It came with a collapsing share price. Investors who chased those high yields didn't just lose their income. They lost their principal too, at exactly the moment they could least afford to. Tom's strategy assumes the dividend is reliable. History says it isn't always. And the yields that look the most attractive are often the ones that are warning signs in disguise. Now here's where the story takes a turn that even most index fund investors miss. Because the gap between Tom and Harry doesn't just live in returns and tax drag. It lives in retirement, too. And the way it plays out there surprises almost everyone. 30 years later, both men retire at age 60. Harry's index fund, approximately $1,780,000. Tom's dividend portfolio, approximately $1,410,000, a gap of $370,000, and cumulative federal taxes paid during the accumulation years. Tom has paid roughly $48,000 in dividend taxes. Harry has paid approximately $3,000. A $45,000 swing handed to the IRS that Harry kept compounding instead. But it's in retirement where the final twist of this story lands. And this is the part that changes everything. Tom's dividend portfolio is now throwing off roughly $56,000 a year in dividends. He doesn't have to sell a single share to live on. The cash arrives automatically. And on the surface, this looks like his vindication. 30 years of building passive income have delivered exactly what he designed them to deliver. A retirement that pays itself. But Tom owes taxes on every dollar of those dividends in the year they arrive, whether he wants them or not. After federal taxes on the mix of qualified and non-qualified income, Tom takes home somewhere between $48,000 and $50,000 out of his $56,000. And he has no control over when those gains are recognized, no ability to manage his taxable income strategically, no way to smooth his tax exposure from year to year. Harry, on the other hand, has to sell shares to fund his retirement. That sounds worse. It sounds like depleting the machine. But here's what almost nobody talks about. Harry has complete control over when and how much he realizes in capital gains. And in 2026, the federal capital gains tax rate for long-term holdings is 0% on gains up to roughly $48,350 for single filers. Harry has been holding his index fund for 30 years. When he sells shares to raise $50,000 in living expenses, only a portion of that sale is actually a capital gain. The rest is a return of his original cost basis. By managing his withdrawals carefully, Harry can keep his realized gains inside the 0% bracket. His federal tax bill on a $50,000 retirement year, close to zero. Tom's tax bill on his $56,000 in dividends, $6,000 to $8,000 in federal taxes before state taxes even begin. Same retirement lifestyle. Completely different tax outcome. And Harry still has $370,000 more in principal, actively compounding for as long as he lives. The dividend strategy that spent 30 years looking like the obvious income winner just lost the income comparison in retirement too. But this is where I have to be honest with you. Because if I left the story here, I'd be doing exactly what I accused the dividend community of doing. Telling half the truth. Dividend stocks are not inherently broken. They are situationally misused. Inside a Roth IRA or a 401k, almost everything I just described stops being true. The annual tax drag, the single most damaging cost in Tom's 30-year story, disappears entirely. Dividends inside a Roth IRA are never taxed. If you want dividend exposure, a Roth account is where it belongs. Putting dividend stocks in a taxable brokerage account when you have Roth space available is one of the most expensive sequencing mistakes in retail investing. The math doesn't change. The location does. There is also a behavioral reality that the numbers don't capture. Dividend checks kept investors in the market through 2008. They kept investors in the market through March 2020 when the S&P 500 dropped 34% in 5 weeks. There are real people who would have panic sold an index fund and didn't sell their dividend portfolio because the income kept arriving. If the dividend check is the thing that kept you invested through the worst crashes of the last 20 years, then the behavioral advantage of dividend investing may genuinely outweigh the mathematical disadvantage. Not for everyone, but for some people. And it matters. Dividend growth stocks. Companies that have raised their dividends for 25 or more consecutive years have also historically delivered solid returns at lower volatility than the broader market. As a complement to a core index position held inside a tax-advantaged account, they are a defensible allocation. The word is complement, not replacement. And that word is where the real story ends. Tom didn't lose because dividends are bad. He didn't lose because he made a terrible decision or ignored obvious evidence or failed to do his research. He lost because 3 small leaks, a roughly 1% return drag, a 0.5% to 1% annual tax drag, and a fraction of a percent in higher fees, ran simultaneously, quietly, invisibly, for 360 consecutive months. Not one of them was dramatic in any individual month. Every single statement he ever received showed his portfolio going up and his dividend income growing. The strategy felt like it was working every single day. It was costing him money. That is the most dangerous kind of financial mistake. The kind that never looks like a mistake while it's happening. Harry won not because index investing is exciting, or because simplicity is its own virtue, or because passive is always better than active. Harry won because he minimized the three things that compound against you in a taxable account over long periods: taxes, fees, and return drag. And then he got out of the way and let the market work. The real lesson here isn't dividends bad, index funds good. The real lesson is this: before you choose a strategy, understand what it is costing you. Not just in bad years, not just in dramatic collapses, but in the quiet, invisible, compounding cost of how your investment is structured every single year in every single market condition. Tom thought he was building passive income. He was. He was also building a tax bill, a return gap, and a $370,000 shortfall he never once saw on any statement, because his account always went up and his dividends always arrived. And those two facts felt like the whole story. They were never the whole story.